Okay, I would like to talk about Treasury stock. Now, what Treasury stock is if you look at this here, I've got this section of the balance sheet that's similar to the one we looked at earlier, but I want you to look at this and recall that if this is the situation, it means that 1,000,000 shares have been sold to the public of common stock. The par value is $1, and of course they didn't have to sell it for their par value because that's an arbitrarily low amount, and so they got extra amounts over the par value. So they had gotten $3 per share when they sold these stocks. Well, what happens is that a lot of times companies will promise their executives stock as part of their compensation, and if that's the case, the company can't just print up stock. It actually has to go out in the marketplace. It has to go to the stock exchange and actually buy the shares just like anybody else who would want to invest in the stock. So if this company, I've got this example here, let's say that they wanted to buy back 100,000 of its own shares, and let's say at the time the price was $6 a piece, it's going to actually have to pay 600,000. Now, what you're going to debit is, we're not going to actually debit the common stock and paid in capital account because we want to keep it in a separate account called Treasury stock. So what we're going to do is, debit Treasury stock. And the amount, again, is the price or the cost that you incur to buy these shares times the number of shares that you buy back. So if you look, it's a debit to a shareholder's equity account, just like you have the expenses and dividends. This is called a contra equity account. It's got a normal debit balance because it decreases shareholders' equity. So what it looks like on the balance sheet is you're going to have this line item, and notice it has the parentheses around it because it makes shareholders' equity lower or less. So what you have to understand with Treasury stock is this number can become a larger, if you will, negative amount or debit balance when they buy back their own stock, but the company probably is going to turn around and reissue those shares. Now, the entry to reissue, the debit we're not going to get into, but the credit, when you reissue those shares that you had previously bought back, you would go ahead and credit the Treasury stock, making this less of a negative amount. So this amount basically you'll find goes up and down as they buy back their own shares and then reissue them. Now sometimes they give them away as compensation, but typically what happens is you have what's called stock options, and the idea behind it is the executive who has these stock options will turn this stock option in, and the company in exchange will give shares of stock, but will also expect some money. So the entry is a little more complicated when you reissue, but the idea is that this amount will become more of a negative amount when the company buys back its own stock, and it will become less of a negative number when it reissues those shares. Now, shares outstanding is another important concept, and that's basically, in this example, it's your number of shares that were originally sold, the number of shares issued. Now, those would be the shares outstanding if the company didn't have any of its own shares in its own possession. So shares outstanding basically is the shares that are still out in the public's hands. And so you subtract the number of shares in Treasury, not the dollar amount, the shares, to get 900,000 shares outstanding. Now, why do we care? Well, that's the number of shares that will share in the dividends and to share in the earnings per share. So in other words, these 100,000 shares that this company has of its own shares, they're not going to pay themselves a dividend. So sometimes what companies will do is they'll buy back their own shares just to help reduce the amount of dividends that they'll have to pay. If there's fewer shares outstanding, then there's less that they'll have to pay out in dividends. Another thing that can happen, and it is legal, though I feel a little unethical, is a company might see that their stock price maybe is not as high as they would like it. Just the act of buying back their own shares, what you're basically doing is reducing the number of shares out there. And when there's a lower supply of something, the demand being the same, the price will actually go up. It's the principles of supply and demand. So they can buy back their own stock and affect the actual price the stock sells for on the stock market. It's an expensive thing to have to do, to buy back your own shares, but it has been done. So again, treasury stock, it's a contra equity account and makes shareholders' equity go down, and then these shares will often get reissued. And that's treasury stock.